Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today, we'll explore how to effectively use Creditor Tools, specifically insurance risk. NACARA aims to bridge the gap between debtor and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. Insurance, title insurance, hazard, flood, and general liability. To protect the creditor's interest, in other words, their loan commitment amount, the debtor will be required to have and maintain adequate and appropriate insurance coverage always. Let's first talk about title insurance. For real estate financing, this insurance will be required to verify and protect the creditor's intended lien position on the property. Most creditors will structure the loan to be in a first lien interest and will require that that position be insured via an ALTA, an ALTA lender's title insurance policy. Such a policy is designed to protect the creditor against possible claims or other issues on the title to the real property, namely correct ownership vesting, title defects, lien priority, unrecorded mechanic liens, assessments, encumbrances, encroachments, easements, water rights, mining claims, patent reservations, and conflict of boundary lines. The policy is designed to insure the creditor against any loss for the entire length of the loan. Prior to booking the loan, the creditor will receive a commitment for title insurance showing the status of the property, so the creditor's documentation and interest will be properly prepared for recording. Next, hazard insurance. Insurance that covers property damage caused by wind and fire, severe storms, hail, sleet, and other natural events, to the extent those things are covered in the policy. Creditors will require an annual policy premium to be paid or in place always. The creditor will be listed as the loss payee in the event of a claim. Flood insurance. Where applicable, where the real property is in a flood zone, flood insurance is required on all loans that are secured by real property. The creditor has procedures in place to verify whether the subject property is even in a flood zone, per these flood zone maps, and requires flood insurance or not accordingly. If so, the debtor will promptly be notified, as the loan will not be closed without flood insurance. General liability insurance. The creditor will be named as an additional payee for this insurance coverage, to be protected from a variety of various lawsuits and similar claims. Such claims may include bodily injury, property damage, personal injury, and others that can arise from the debtor's business operations that involve visiting customers and vendors. Builder's risk insurance coverage will also be required in the course of construction, building, and renovation projects. This insurance indemnifies against damage from physical loss or to buildings while under construction. So why is the insurance risk important to you? Updated title insurance prior to foreclosure. In a distressed problem loan scenario, potentially involving foreclosure of the collateral, the creditor is going to do a credit file review to determine the status of its collateral. Current insurance coverage is part of that review. The creditor is expecting there to be an original title insurance policy with all of those endorsements. This confirms his insured interest as a creditor in the real property at the time of the loan that the loan was originated. Now, however, a new updated title report will be necessary to verify who the current vested owner is, and whether there are any newly recorded exceptions or liens against the property. The creditor needs to ensure his lien interests are what they were expected to be. Unpaid taxes and mechanic liens may pose a challenge to the creditor's interests, and will have to be researched and addressed too. Forced placed insurance coverage. It is possible that you may not have the funds to maintain adequate hazard or flood insurance coverage. It has happened. Creditors, however, by virtue of your signed loan documents, may find and apply some type of forced placed insurance coverage and add the premium cost to your loan balance. You may or may not be able to care about it, depending on your financial condition, but you should always care about it. If you can repay over the long term, for example, know that it will be very expensive to you, and you're going to pay all that forced place insurance premium. If you will not be able to hold on to the collateral property, it will likely be part of an unpaid deficiency balance that you may be responsible for. Always try your very best to keep appropriate insurance coverage in place. Debtors, you need to honor the terms and conditions of the loan agreement. In those times where it's not possible to service the debt and maintain operations, the debtor should always keep appropriate insurance coverage in place. If you must make adjustments to your pro forma cash flow that lower the net available cash flow to service debt to cover for adequate insurance, then so be it. In other words, when you're preparing a pro forma cash flow to show what you think it is, put insurance coverage in there. Yes, it'll increase how much deficient your cash flow is going to be, but you want to show and pay for your insurance coverage. With detailed financial statements and a well-prepared pro forma cash flow statement, the insurance costs can be identified, like I said, put in there, and reconciled with the remaining cash flow to service the debt. The creditor will realize that the insurance coverage will be paid for under the ordinary course of business. It's in your pro forma. And there will likely be less available cash flow for debt service. It is expected that corrective actions will be taken to improve the cash flow to normal and improved levels over time. Meanwhile, the insurance policies designed to protect the interests of all parties will remain viable and in place. In other words, they'll restructure the loan repayment terms with a lower payment because you put insurance coverage in there and you paid for it, and realize that later on you'll hopefully be able to survive and continue, and that way your insurance is covered and everybody wins in the long term. And you don't have that forced place insurance, which can be extremely expensive. I'm sure you understand what I'm saying. Thank you for joining us today. We covered the Creditor Tool insurance as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, inputs, recommendations with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own repayment solutions. Thanks again.